Hello, and welcome to Portfolio Matters. In today's episode, Mahad Ahmed will be taking us through some small caps that he likes. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, Mahad, why don't you introduce yourself to the audience?
Okay, so I'm a student of economics. I've officially been investing now for about just over a year.
Okay.
But I've been more of a watcher for several years before that. Obviously, when you go to university, it probably wasn't the best decision, but you get a bit more money, and then obviously with COVID, there wasn't a lot of spending that was happening.
Sure.
So you obviously get extra money. So I decided to sort of do a bit of education first and research, because I'm quite good at research, or I quite enjoy research. So I sort of indulged myself on that. And then, I just took it from there. So, yeah.
Right, great. So what sort of, what resources are you using to research these stocks, and what sort of stocks do you like?
So generally, I tend to use Stockopedia
to
firstly filter the stocks. And then after that, obviously, having a look at, I'm more of a value investor. So right. I like to do different kinds of cash flow and stuff like that. Obviously, for me, there are certain sectors I just completely avoid because of religious reasons, so stuff like the financial stocks, but also some other stocks that I just don't believe in, the sectors like the healthcare, energy generally. When I first started, to be honest, I was perhaps too interested into whether they were a value stock as opposed to whether they were a good business as well.
Okay.
And that obviously meant that I was looking at some stocks that were heavily commodity based.
Right.
And I think ever since then, I think I've become more into a quality business as well as a value business.
Right. So when you say you're screening for stocks, you're using Stockopedia. I mean, what screens are you using? What are your criteria?
Criteria, so that they do pay a dividend.
Yep.
That it has a sound financial basis. So stuff like the F score is at least, say, 6. That the Z score, the Z score is at least 2. Mm-hmm. And then also making sure that in terms of its gearing, that it's, say, below about 30%.
Okay.
So generally looking at the financials and making sure the financials are very strong. And then after that, I'm quite open to just having a look and see what. Yeah.
Okay, so from just the criteria you're talking about, I mean, you have a clear value bias. And one thing you haven't mentioned is earnings growth. And that would be one of the things that I would be looking for in companies that, because the trouble is with your approach, and frankly, with something I've struggled with historically as well, is, if you look for value stocks, you get stuck with value traps, i.e. companies which are great value because their earnings aren't going anywhere. And what you want to do is find stocks which are good value, but which have very good growth prospects. I mean, some of the stocks we've covered, like Capital Limited, the drilling company, I mean, that is both value and has had really good earnings growth in the last couple of years. That's the sort of stock that, I kind of aim to discover on this podcast. And on that note, shall we just look through the stocks that you have produced this presentation on? So, Ahmed, what is the first stock you'd like to discuss?
So the first one is Michelmersh Brick Holdings. Now, the company's got a market cap of £112.
Sorry, 112 million.
Yeah, 112 million. It's got a P ratio of 40, or approximately 14, and a dividend of 2.99%. To put it bluntly, what it sells is what they call premium bricks, which to me, if you put it basically, it's like they sell a sexy bricks, you know, right, in the sense that it's not the standard brick, it's more premium, more for architectural design works. And they can perhaps be sculpted into pretty patterns and stuff like that. So these structural companies that they sell these bricks, but they have 6 factories. And about 2 years ago, or I think it was about, yeah, it was probably, I think it was completed during COVID, and it was started just before COVID. And they bought a factory in Belgium, so they've now got 6 factories. They've got a market share of 5%. Of course, as they're a premium brand, so that it's not as if they're going to be, you won't see them as, it's obviously a premium brand is not going to have as large of a market share. So what it offers is a bespoke service, including handmade blending. So obviously that means that it can sort of try to differentiate itself. And it's got high standards of quality assurance, and their products or their markets overall would be housing, urban regeneration, and what they call RMI, which is just repair, maintenance, and improvements.
Okay.
So in terms of their growth, I would say the first one is remote working. And obviously that's enabled people to move to many areas of the country that were previously abandoned for lack of work. And this is in particular for middle-class households that perhaps can work from home. And there's this whole idea of a chase for space also developing, you know, that people want to be able to find more space in a post-COVID era, where they found that the housing is a very, very important thing, and people just want more space. And they're seeing that there's been a big review of people's lives and whether they want to be living where they want to be living, or whether they want to be working. And I think this is a large part of it as well. The second thing is that housing stock is actually getting older. Now, if you look at the number of houses that were built, I've obviously put down there's 30 million houses that were built at least 50 years ago, whereas only 5.5 were built in the last 40 years. If you take it to 2003, there've only been about 3 million. It's about 2.8 million exactly. And pre-1990, the number of houses in the housing stock that were built pre-1919 is actually 4.8. So there is a growing market within this repair, maintenance, and improvements. And on top of that, there's some government intervention that can push this forward. And the first one is the government home building fund loans. And these range between 250 and 250 million to try and cover the costs of creating these houses. There's also the government's housing target of 300,000 houses a year, which is mostly aimed at trying to create houses for the market. But then there's also going to be some that are going to be for social housing. Now, the third one is also a government intervention. Now, this has Help to Buy. A few months ago, there's actually a documentary on that alerted me to this, and it was, I think it was called The Decade, the Rich One, on the BBC iPlayer, I think it was. And they showed a graph of how housing prices rose around the time of Help to Buy. And so between 2010 and 2013, there wasn't much housing growth. Or the price of the housing hadn't risen much above the 2008 level, up until Help to Buy was introduced. From that point, housing has increased by, I think, it was about 160,000 on average in the UK. Now housing is about £270,000. So percentage-wise, I don't know the exact percentage figures, but it's definitely above 50%. There's also the fact that, there's also higher prices of housing as a result of the stamp duty tax holiday that has resulted in a higher housing price. Of course, the housing price now is not being supported by a stamp duty tax holiday because it's been reinstated, I think, either this year or the year before. But that's also resulted in higher housing starts. So the number of housing starts are now at a level or that is about the or close in the same area as just before the financial crash in 2008. Obviously, with a rudimentary economic understanding, generally what happens is if the price rises of something, more people want to supply it. And obviously, there's been an issue with supply in the last a decade with rising homelessness and stuff like that. But the housing supply hasn't actually risen. There's also the brick production has risen by 50% in the last 10 years. That's per year, and the brick stocks are they're reported to be quite low due to high demand. Now, the positives, as I've said before, the strong market indicators with the post-COVID situation, the housing supply slowly increasing, and the age of the housing stock. Of course, it at the end of the day is a brick company. So if the production of bricks across the country has risen, then that would also suggest that there's a higher demand. And obviously, with that 5% market share, they will be able to get some of that. And there's also the continued government intervention. They do have a good control of costs, especially in this very inflationary economic situation. They've hedged, I believe, 90% of their energy costs into 2024. They've got a great financial position. They've got an F score of over 6, a net gearing that is, I've actually forgotten exactly what it is. So I won't say what it is, but it is very low, if not negative. Cash has been rising over the last few years. And there is minimal debt, which I believe long-term debt stands at about 1 million, which is great for a company that produces revenue of about 60 million. The dividend yield is approximately 3%. And they are hoping to raise it or have a progressive dividend policy. What's important, of course, as well, is that a company has an economic moat, i.e. stuff that can defend it from competition. So stuff like margins is above what you'd say is a good margin, which is around 10%, 15%. Return on investment or return on a capital invested, or a capital employed, as I've written it down, and return on equity is also above 10%. Now, historical record of growth, it's been able to grow its revenue from 20 million in 2011 to 60 million today, which maybe if you're looking at it as a nominal figure, isn't that great. But if you look at it in percentage terms, or even just as a multiple, it's 3 times, which for a company that only aims to take a certain small section of the market is quite good. There are, of course, high barriers to entry, as they do have physical assets. It's what you'd call a traditional company. And in the sense, it has production and manufacturing. The high capex also means that it's got a high barrier to entry because other companies have to spend a lot to try and get into the market. Yeah, and according to my DCF, which I'll send to Keith, it comes out with a fair value of 190 pounds per share, which would represent a 50% upside.
Great. Okay.
And the negatives. So the first one is the rising prices of inputs. Obviously, there's a higher energy cost, which they've tried to limit. But there's always a lot of uncertainty with what's going to happen in Ukraine. Natural gas prices and stuff like that have risen from something like they've been rising since February 2021, where they broke out from their pre-COVID state, I think. So we've had a market that's had high costs for stuff like for natural gas and oil and stuff like that. And it could continue, and we don't know how long that's going to be. So that's always a risk. The second one's ESG related. So it is a carbon intensive industry. And making bricks does take a lot of energy, and that energy tends to come from the fossil fuels. We don't know in the future if ESG rankings and ESG related things could become regulatory, and the government can step in, since at the moment it's just companies trying to regulate themselves to a degree. And that could and that could really present a problem for the entire industry and not just the company. The third is the further dilutions. Now, for a company that makes money year in, year out, and has been able to grow its revenue and grow its profits, it is surprising that it continues with dilutions. It hasn't properly been explained by the company. And of course, that could put off a lot of people. Because usually what happens is companies would either, they will either take on debt, or they'll take on having to give out more shares. And the issue is sometimes a company can get too addicted to what it's doing, even if the practice is not necessary. The fourth one is lower volume. So obviously the number of shares being traded isn't as high as you would see in other shares, not just because it's a small cap, but also because of the individual stock, meaning a wider spread, which obviously means a more of a cost. And of course, since it's also low volume, it could mean that it could remain undervalued for some time, because obviously you need a lot of people to be looking at it. And if the major ones aren't looking at it, it could present a problem. The next one is that the competition are much larger, and obviously the market share is small, with only 5%. And the number of factories I've put down, because the competition is Ibstock, Forterra, and I think there's another one, German-sounding one called Wienerberger, something like that. And Ibstock has 16 factories. Wienerberger has, I believe, over 10, and Forterra have something like 9 and 10 or something like that. So it is significantly higher, which could present competition if they try to move into the space, which they haven't done so far, but it's still a concern. Now, the next one is housing market. Now, I've put down a history of price fixing simply because government hasn't actually built many houses. I've put a price fixing with those apostrophes, because they've been able to control supply to maintain the price. Obviously, you don't want the price, if you're a developer, to go down. So there's been a lot of land banking in the last decade, which has obviously worked out well for them. But obviously, if you want to create houses and want to sell bricks, it can mean that if the price was to go negative, they could reduce the number of houses being built significantly, and that's not in the company's control, reducing the demand for their products. And the next one is rising interest rates. And obviously, I put down that's going to slow down the market of, which obviously we live in a very inflationary market, or inflationary world at the moment, not just in the UK. And that will affect mortgages. And obviously you have to raise interest rates to try and cut inflation, which is something that the governments across the world are trying to do. And obviously things like a quantitative easing is slowing down. And so, yeah, that could present a problem. And the last one is the new cladding levy on house builders. So obviously that will increase costs on your consumers, which can mean they make cuts on how much of your product they use, or how many structures they build, because houses is the main market, but there are other markets such as educational markets or huge buildings of any sort for any use. So, yeah. So my view is that it's heavily undervalued. That's one of the main attractions. The next one is that it is got a moat. So even though the market share isn't very high, it does have a steady market that's been able to grow. And finally, that it does have a good market drivers. So,
thank you, Matt, for putting all that together. Very interesting. I like the fact it is a niche specialist, but this is a very cyclical business, and I would be concerned that it's too late in the cycle. So a year ago, there was definitely a big shortage of bricks, and I'm sure Michelmersh would have been doing very well there. But now I'm concerned that the rising interest rates, and we're seeing interest rates rise quite quickly, and mortgage rates as a result quite quickly, will tend to slow the market and in particular, housing prices are ridiculously high, as we have covered many times on the weekly. And as that interest rates slow the housing market, so you'd expect house builders' profitability to fall and them to start reducing new house building. In addition, when you say you think the shares are undervalued, that's on the basis of your DCF, which you're going to send me and I'll share on the Discord. But just on the metrics that you provided, so a PE ratio of best part of 14 and dividend yield of 3%. I mean, the shares don't look terribly cheap to me. They look, okay, but not, there's not like a dividend yield of 6, for example. And yes, the revenues have grown very strongly over the last 10 years. They've trebled, which is great, but I'd be really concerned about the continued share dilution. I mean, if this is a specialist brick producer with good margins, then why is it continually issuing shares? That, to me, is a big red flag. In fact, in this week's weekly, I have a chart showing the relative performance of companies that have been buying back shares versus companies that constantly issue shares. And companies that do the share buybacks, you'll be unsurprised to learn, consistently outperform companies that continually issue shares. So that is a concern. So bottom line for me is I think this is an interesting company, but it's the wrong stage of the cycle. And I'd be interested in looking at your DCF, but on the just headline numbers, they don't look terribly cheap.
Yeah, I think it's true with the dilution. That is concerning for sure. Using the cycle to invest is not something that I've been involved in before. So I think that's an interesting. I think that's an interesting viewpoint. I think for sure, if energy prices continue beyond the year 2024, which is the point to which they are hedged, then I think they will be exposed to a heavy degree. But I think in the short term, it depends really not just how long the war is in Ukraine, but I also think it depends on, because there was a rising natural gas price, even I think it goes back to February 2021, where you really see a strong breakout.
Yeah.
And I think also things like supply chain issues can be a problem. But yeah, they may also be short term. And of course, there's also things like a lockdown in China, which even if it doesn't affect the market directly, you do have a knock-on effect, as we've seen with energy, because the UK doesn't buy Russian oil. It tends to buy natural gas. And obviously people go from one market to the other to buy something if they need it, and it can raise prices overall.
Yeah. On the cycle, I think that's one of the main games I play, frankly, is timing the cycle. So when everyone is building houses, then house builders are profitability is high and their share price is high. And I like to buy them when house building is depressed and nobody wants to buy houses, and then the shares are dirt cheap. So, frankly, I'd wait until the next crash, but then you have to have some patience to wait a few years to do that. Okay, what's up next?
So this one's Wentworth Resources. Market cap at the point I made this was 40 million pounds. The PE ratio is 8.7, a dividend of 8.81%. So what it does is it's a low-cost provider of natural gas in Tanzania, and its main market is within Tanzania, and it's listed on the London AIM market, and I think it's headquartered or is in Guernsey.
Right.
Yeah. So this is a Tanzanian natural gas producer. So the way it works is there's a bay in Tanzania called the Mnazi Bay, and it produces about 50% of the natural gas in Tanzania. And natural gas makes up about 30% of the electricity. So yeah, basically they own 32% of the production at the Manazi Bay and 40% of the exploration. They share that with the about 48% of the production is owned by a company called Morel and Prom, which is a much larger energy company that is much more global, and a company called TPDC, which is the government-owned Tanzanian Petrol Development Corporation, I believe. And to be precise, actually, it's not 32%; it's 31.94. But it's very close. But natural gas makes up about 57% of the Tanzanian energy market, and it's growing year on year. Mnazi Bay accounts for 50% of natural gas in Tanzania and 30% of electricity. The gas is then sold to the government or to TPDC, which then transports it through the National Natural Gas Infrastructure Pipeline from the region called Twara region to Dar es Salaam for use in the power generation, industrial application, household cooking, and in the propulsion of transport vehicles. There are many large industrial clients as well, which we'll also get into. And there's obviously the extraction of natural gas is also useful for the government's own objectives for energy security and wanting to become a regional power hub, but also to reduce its carbon emissions, which natural gas is actually less carbon emitting than fossil fuels. So it's seen as almost like a gateway to a cleaner form of energy. A bit of a history lesson. So the company was formed to be in Tanzania in 2003, 2004. So the company has no history before 2003, 2004 that is really relevant, other than perhaps that it was formed as a company. And it has never had operations that are meaningful outside of Tanzania. It was born out of persistent and prolonged drought, which reduced the hydro energy production. And this led to the government to constructing a pipeline to exploit its a gas reserve. And so at that point, it started to give out licenses. And obviously Wentworth Resources was there to be a recipient. One thing I've not written down is that the license was until 2031. Right. So they signed a rough calculation, 28 year. Yeah, I think that's 28 years from 2003. And in 2015, they started to properly produce natural gas from the Mnazi Bay. And this obviously meant a revenue growth from 1 million or less than 1 million in 2014 to over 20 million in 2021. Now, growth. The government aims for universal energy access by 2030. Less than 50% of the population have access to electricity. Electricity access has grown more than twofold to 38% from 2013 to 2019, even as population increased by over 20% during that period. There's a desire to reach 5,000 megawatts from a position now of 2,000 megawatts by 2025. Which, although ambitious, shows that the government's really pushing this hard. There's also rising industrialization, and the industrial component of GDP has risen from 24 to 29% in 5 years, even as the annual GDP growth averaged about 6%. The government's target is for industry to be a share of GDP of 40%. You've also got 2022 growth. So in this year, they're aiming, or the way they're trying to grow is that they're trying to create a gas pipeline from Dar es Salaam to Mombasa. So this is to further their aims for the country to be a regional energy hub. And there's a Kinyerezi power plant, which is now being expanded, which is one of the main consumers of this. Among a load of other ones, such as the Ubungo, but in particular, the Kinyerezi power plant is being expanded. So with the pricing, they have contract pricing. So they pre-agree with the government, which the company hasn't outright stated how long each contract is, which is something that they haven't communicated. But what is true is that each contract's price has to be it's stuck to. So even if the price of the overall market across the world has risen, which it has, you won't be the beneficiary of it. But at the same time, if that high price is maintained over a long time, as it is now, the price may rise as well. So you may benefit like that. And then, and of course, also on the downside, if the price does completely drop off the face of the earth over the next 6 months, their price has been pre-agreed. And this is increasing from the start of this year from 3.35 MMBTU in dollars, of course, to 3.44 MMBTU in line with US CPI, which the company has stated, although I'm not sure that's factually true from the company, because I'm pretty sure CPI has risen by more than, I think I calculated that to be about above 2%, but lower than 3%, which I'm pretty sure that CPI has been above 5% over the last year. But production has averaged across the entire bay at 81.66 MMSCF per day during 2021, with the gross production that's attributable to the company, which is 31.94% of production. That equals to 9.5 BCF. And the production target for Wentworth is between 8.8 next year to 9.9. And to explain the table, this just shows the gross reserves, that's as a percentage of what they own. So this is specifically to what the company owns. So if you go off the total proved and developed, they've got the 5.5 years of the production left of their total proved and developed. And this is at the 2021 rate of 9.5. And of course, you can see it gets higher and higher as it gets more speculative. So the positives are that it is undervalued by traditional metrics. I believe the price to books is below 1, and the net asset value is 32p when the share price now stands at 22.5 pence, which represents a conservative upside of 40%. ESG is another, because the company can claim to be much better for the country than the alternative of having to import halfway across the world humongous barrels of oil that are going to be even more polluting. Although, of course, natural gas isn't a perfect solution, but it is what you'd call a gateway fuel. The third one is Tanzania. It's got a growing economy. It's averaged 6% over the last 10 years. There's been increasing industrialization, and obviously rising population means a wider client base over time. There's been a political push, obviously, with, as I've said before, they've got universal energy access. And so the government's trying to push this quite far. Excellent financial health. It's got rising cash. In fact, cash is, it stands now at 23 million, which I believe is about the same or in the same ballpark as the revenue, which is very high. And with market cap at around 40 million, its cash makes up half of the market cap.
Wow.
Which is a lot of cash. And obviously they've entered profitability back in 2018. This was after years of heavy investment, and they've cut back their capex. So that's obviously freed up a lot of cash flow over the last three financial years. They've got a net score of 8. They've got a negative net gearing since they're actually debt-free. And it's been debt-free since the end of last year, having reported that it paid off. It reported in December last year that it paid off in 2020. In January 2020, it paid off the last of its loans. It's got a good financial position. And of course, the dividend yield, now I said currently above 7%. That can fluctuate, of course, as the share price fluctuates. Obviously it's got a history of returning money to the shareholders and historical revenue growth, as I've said before, from 1 million in 2014 to 20 million in 2020. The negatives are it's a single asset producer, so there's obviously always going to be a risk there. I have asked questions at earnings calls, and from what was said and from history, it doesn't seem like they're that interested in trying to find, with a proper purpose, another asset. So it seems like they are just interested in trying to increase production at this particular place. And I've also actually not written down that they relinquished the license in Mozambique, which they told shareholders in their 2020 annual report. So it seems they are focused on Tanzania and on this particular one. There's a single buyer, so that's obviously a risk. And there's also, in fact, a single buyer that's a political single buyer. So that could present a risk if the government wakes up one morning and changes its direction. It's got, from what I see, other than increase in demand, it doesn't seem to be wanting to grow. And that obviously creates limited growth potential. So it could just stay with its revenue around the same area, unless production was to increase. Of course, the upside to that is that they've actually got, they don't really have to increase the amount of money they spend on CapEx to increase their revenue, which is a very good thing. You have a dividend cover, which I believe, from what I understand, a good dividend cover is 1.5 approximately. Their dividend cover has never reached 1.5. It's been in between 1 and 1.5, currently standing at around 1.2, 1.3, which could suggest that it's overpaying. And of course, it's only been paying a dividend since 2020. So it is a relative new, it's a new player. It actually paid its first dividend in October 2019. And it's been maintaining it since then and been able to grow it, which has obviously been a good thing for shareholders. Low liquidity means the share price, the spread is now 5%, which is quite a lot and can off-put some people, which is understandable. Of course, it doesn't have as much coverage from brokers, although I do remember on Stockopedia, one of their little newspapers, they did cover it on a stock pitch. So over time, I think if it does continue to pay a dividend, that could change. The contract structure, of course, is a problem because it doesn't give you a good upside if the price of gas goes up, which is a huge issue. There is a currency risk. The balance sheet's in dollars, but they also obviously they will have to buy things in the local currency. And there is obviously going to be an exposure within the country to the local currency. So you potentially have an issue if there's exposure to both currencies, as well as the pound, which, and obviously the fixed price means, and I've already repeated that one, yeah. So overall, it's heavily undervalued. It's obviously heavily asset rich, and the company is buying back shares. And it said that itself, because of the net asset value, I thought I'd included it in the share in the positives, but I seem to have forgotten. But it's bought back its shares in the last 2 years. It's almost given it as a Christmas present because it comes along in December. And the shares have fallen, although they were rising. I don't have the exact numbers, but you can probably find them on say Stockopedia or something like that. And it has a track record of that. And I think the company is trying to always increase shareholder value by having the buybacks and dividends. The rising demand in a country that needs energy, and obviously a strong financial position coupled with the dividend.
Great. Thank you, Mahad. So I think this looks really interesting, actually. A company with half its value in cash, I mean, that means that it could buy back half the company, and then the shares would be, metrics would be, twice as good as they are now, and they're pretty good now. With Stockopedia have it on a forward dividend yield of 8.8%, which is really good. And the one thing I would say is this looks like it doesn't have much production growth. Its contracts seem to be linked to US CPI. So it's not going to get the upside from the increase in global energy prices. But, if you just look at it on dividend yield, this looks like a pretty good bond, actually, yielding 8.8% real. So that looks very attractive, and the potential were share buybacks to boost the share price. And, if they were to buy back half the shares, then suddenly you've got a dividend yield of 16 or 17%, because you're paying out the same cash flows on half the number of shares. So that looks amazing. The one thing I would be concerned about is the geopolitical risk. So Wentworth are trying to get their dollars out of this country in order to pay shareholders. And we know that food prices are rising and energy prices rising. So emerging market countries are suffering from deteriorating balance of payments. And I've had a look at Tanzania, and it runs a current account deficit. So that would be the concern. Are they getting paid in dollars, or are they getting paid in the local currency? And if they're getting paid in the local currency, then they've got big exposure to currency risk. But as you say, it's an emerging nation with a growing economy and rapidly growing energy demand. So that's an attractive proposition, and the shares look very good value. So thanks for sharing that. Okay, next up.
So I chose one that was a bit left of field, just because I was looking through the British stocks, and generally, I just thought just to spice it up a bit. So a Global Blood Cord, this is a Chinese company that's listed on the American markets as what they call American Depository Receipt. It's got a market cap of 350 pounds. Obviously, it's listed in dollars. The PE ratio is 5.7, and it has no dividend. So it's got a dividend yield of 0. So what it does, it calls itself a life science business that stores umbilical cord blood stems. Stem cells, to put it bluntly, they're just unspecialized cells. You can turn them into anything, and they can help to solve a lot of blood disorders. And they're they're a scientific marvel that is quite a mainstream science. So it's nothing special there in that sense. They see themselves as a one-stop shop for this. So they offer cord blood collection, cord blood processing, laboratory testing, and the cord blood cryopreservation. Stem cells, as I've said, they do specialize in, or they will become specialized, and they can treat a lot of things. Apparently, umbilical cord blood has 10 times more stem cells than the bone marrow, which is another place where you can find stem cells, and can treat over 75 diseases and disorders. The storage is usually for 18 years, at which point the child takes control of the sample. So obviously 18 years for the child, and that obviously means they have a customer for 18 years. And the processing fee is approximately 9,800 RMB, which is what the company reports. And the annual storage fee is 860 RMB, but that's 860 multiplied by 18. It works out like that. And the market is just ordinary consumers and the public, usually middle class, usually have one child. And obviously China's, the people have got rich, and, it's created a market for them. Growth prospects. It holds 3.5% of the 7 cord blood banking licenses in China, making them the largest by far, and with with only one license per region. It covers areas with over 20% of Chinese births. However, 70% of the population have no licensed operator, and the company would be in pole position if they were to be opened up to the nation. The Year of the Dragon. So this is to do with the Chinese calendar and how it affects the Chinese birth rates. Currently, we're not in a good birth year, but in 2024, they come around every 12 years. So every symbol is every 12 years. And the Year of the Dragon is 2024. and tends to mean higher birth rates in accordance to Chinese culture. There's obviously a 3-child policy that is now being introduced after they had the 2-child policy introduced in 2017, I believe, which could raise the number of samples stored at the family as family subscriptions rise. Now, there's a few other things I've also not added on here, which is that they've grown their subscriptions base. So it's obviously a subscription-based company from 23,000 subscriptions in 2007 to over 900,000 in the last reported year. And they are also, as a company, they are invested in a company called Cord Life Singapore, which is a similar type of company that functions from India to Vietnam, so it has a wider geographical base. And also they are connected to 383 hospitals. So, yeah. The positive, so the valuation is traditionally, on traditional valuation, it seems to be overlooked, and also by DCF, which I could forward to Keith as well. And it's rejected a buyout offer twice in 2019 June. I think it was offered by the company that it owns the 10% in, Cord Life Singapore, tried to buy the company for $7.50 per share. And then another company that is called Alternate Ocean, which is a subsidiary investment fund, tried to buy the company in March last year for $5 a share, which it rejected around December just last year, so 4 months ago. So it seems that the company itself sees itself as undervalued, and it doesn't want to sell the company for less than they see what it's been worth as. But it also shows that the company can be seen as attractive by others. There's also the strong market conditions, the year of the dragon, as I've said, in 2024. It operates in fruitful regions, which represent 20% of Chinese births. And actually within the 7 licensed regions, which I haven't written down, 49% of the births that happen in the 7 licensed regions, 49% of the births in those regions happen in the regions that they own. So because they own only 3.5% of the licenses, which is 3.5% of the regions. So that suggests they've got a large position within the country. You've also got, of course, the change of the policy with children and also the medical possibilities. The financial position is really good. They're pretty much debt-free because their interest cover is also very high, and they are cash rich. The last time I checked, it's 6.5 billion in renminbi, which I don't know what the exchange rate is, but I'm sure you can have a look at that. It has a wide moat, so the margins have been strong. So has the return on equity and the return on capital employed. Competitive advantages, obviously, it's got governmental support. It's actually not just through the licenses, but last year, in 2020 December, the National Health Commission said that it would not have any new licenses for a while, which means that there won't be a change in the short term or in the near short term. And the ownership and restrictions of licenses helps. And obviously, if things change, they have the money to offer and expand it to the rest of the country. The negatives is a lack of a dividend. So I think one of the reasons it's overlooked is the lack of a dividend and the lack of buybacks, which obviously means that you're only relying on a capital appreciation to actually make some money. The next one is a further dilution. So since 2018, they actually haven't had any dilution. So they've stayed at that 121 million level. And so there hasn't been any change, but they haven't also bought back. So it suggests that the further dilutions is possible. Of course, it's possible, but at the same time, they haven't done it, but they haven't also bought back. So they may just stay at this level for some years, which also further annoys shareholders because you don't get your money back in that form. Also with China, generally China is a risk. There's been, in 2020, there was the education sector in China was wiped out. The government wanted to be more quote unquote socialistic. and reduce inequality in education. So they turned all the education stocks into, or the education companies into non-profits, which spooked the markets. And you will see companies like Alibaba and also Tencent and a lot of the other Chinese companies also experienced a downturn in the market at the same time. And there's also the threat from the Americans and the Securities Exchange Commission with a delisting and things like that. Obviously, they've had a trade war and some spats. And there's regulatory risk from within China. Of course, if a company always has a large market share, there's always a risk that the company itself might become a threat of its own government in any country. And what they would call reforms, which obviously would harm the company. The next one is advances in biology. So if the science changes, the Chinese calendar as well, this year isn't looking to be a good year for birth rates. They call it the year of the tiger, and traditionally people don't want to have children in the year of the tiger, although the drop in the birth rates isn't as big and the rise isn't as big. It's more of a smaller fluctuations around a sort of mean per se. And then there's also, if the prescriptions fall, or if this subscriptions fall, and there's also currency risk. Obviously, it's listed in renminbi, or it's the balance sheet's in renminbi. It's listed in dollars, so that's two different currencies, along with your own pound. Because if the UK economy suffers, then the exchange rates could be problematic. And of course, the child policy. Whether it's not so much the child policy changing; it's more if it will work. The two-child policy hadn't had the effect, and so then they introduced a three-child policy, which it's of course difficult after 40 years of saying you can only have one child. So this is a cultural change that they're trying to implement. But of course, you could also say that with China, a lot of things are possible. So overall, it's undervalued simply because of the amount of cash on hand. And of course, by DCF, it's undervalued even more, which I can offer up the DCF to Keith to put into the Discord. There's a wide economic moat. Its margins have always been good. And the other things that make up the moat have been good, so it helps for competition. My personal opinion is with China is that the fears will die down with time, or I'd say maybe hopes. In particular, because the government has reassured shareholders that it won't go any further. And there are a lot of American investors that are well known that are still invested in America, or still invested in China. And Western funds are still seeing China as a route to make money. But whether that will happen in the short term is unknown, of course. But yeah, that's just a...
Okay, well, thanks, Mahad, but I'm going to completely disagree on this. I should say that I am half Chinese and I don't trust the Chinese as far as I can throw them. So I would say that I have done a My Worst Trade podcast, which I'll include a link to, which discusses my investment in Asian Citrus, which was another Chinese company listed in the West, which had a P ratio of 1. But actually, all the earnings and all the accounts were fake. And my problem with investing in Chinese stocks is I just don't believe any of the numbers. And I also don't think that your shareholder rights are enforceable. I'll also connect a link in the podcast description to our short piece on VIEs, which are the various variable interest entities, which are what you actually own if you own a Chinese stock. And, when you were talking about the shares being undervalued, but it not paying a dividend or doing buybacks, I mean, frankly, this is precisely my concern about Chinese companies. They'll tell you whatever you need to hear to invest, as long as you're paying them the money. Just don't ever expect them to pay you any money in return, essentially. And the thing about the VIEs, which is a structure that Wall Street have concocted to get around Chinese ownership rules, is that essentially they're unenforceable. The few times they have been challenged in Chinese courts, the Chinese courts have basically quite rightly recognized that these are attempting to get around China's ownership laws and have struck them down. So I personally would not touch Chinese companies, and I'm sure the shares look great value. They'll produce whatever numbers they like to get you to invest, but whether those numbers are real or not is an entirely different matter.
Yeah, I think that's it's a very fair assessment.
But anyway, thanks for sharing it with us, and thanks for all your hard work and introducing us to 3 companies we haven't previously covered. So, so all that remains to say is thank you for watching. Please, can you press like and subscribe to the channel? And it's goodbye from Mahad Ahmed, and it's goodbye from me, Keith Jordan. Goodbye.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.